So looking to invest in individual stocks or REITs, there's one thing that you cannot avoid, which is to look at the financials of the company you're planning to invest in. And the first step in doing so is to start the three main financial statements, namely the income statement, balance sheet, and cash flow statement. Not sure how to analyze these statements? Fret not. I'll take you through a step-by-step guide on what exactly these statements are about and the things to look out for. Let's start with the income statement. As the name might suggest, the income statement records how much a company makes from its business operations after accounting for related expenses. To better explain the terms in the income statement, I'll be using SGX Group's FY 2023 income statement as an example. As you can see, the first line on the income statement is the company's revenue. You'll notice that in SGX Group's case, they actually broke down the revenue into the relevant operating segments. This may not be the case for all the companies, as some will just put revenue as a single line item, while the individual operating segments would be in the footnotes of the financial statements. It's always good to break down the company's gross revenue into its relevant operating segments. This gives you a clearer idea of the company's business operations and which segment contributes the most to the company's revenue. Also, you'll notice that in SGX Group's income statement, there is no cost of revenue or cost of goods. The cost of revenue is basically the material cost of making a company's products. By deducting the cost of revenue from total gross revenue, you will get the company's gross profit, and the gross profit margin is basically the gross profit as a percentage of a total gross revenue. The gross profit margin is a good indicator of how profitable the company's sales are in relation to the material costs incurred. After the gross profit, the next line on the income statement would be the operating expenses. This section will include things like staff salaries, marketing expenses, and expenses in research and development, just to name a few. These expenses are basically needed to sustain and grow the company's business operations. By deducting operating expenses from gross profit, you will arrive at the company's EBITDA, which stands for earnings before interest, tax, depreciation, and amortization. Before proceeding to the next section of the income statement, I want to highlight that there is a cash and non-cash portion of the income statement. Simply put, cash portions of the income statement covers whatever cash inflow or outflow that is expected to be generated or expensed. The non-cash portion, on the other hand, has no material impact on the company's cash and is often due to paper gains or losses and accounting principles. Some examples of non-cash line items include gains or losses on foreign currencies, valuation gains or losses for physical properties, and depreciation and amortization of tangible and intangible assets. In addition to cash and non-cash portion of the income statement, there is also operating and non-operating expenses in the income statement. Whatever I mentioned earlier with regards to revenue and expenses from the operating portion as directly related to the company's sales. The non-operating portion includes income and expenses that is not a direct result of the company's business operations. This could include dividends and interest received for the investments made by the company. Interest expense on debts would also fall under the non-operating portion of the income statement. After accounting for all the above and the amount of taxes paid by the company, you will then arrive at the company's net income or net profit. Similar to the gross profit margin, the net profit margin is a percentage of the total gross revenue, and it indicates the overall profitability of the company. The final line item on the income statement will usually be the earnings per share, or EPS for short. This value is derived by taking the net income and dividing it by the total number of shares available. You will notice that there is a basic EPS and a diluted EPS. The difference is that diluted EPS accounts for all shares, including those reserved for employee stock-based compensation program. This is why diluted EPS will always be lower than basic EPS. So that's about everything for the income statement. Phew. Let's now move on to the balance sheet. For the balance sheet, it's a record of all the company's assets, liabilities, and equity. The reason why it is called a balance sheet is because the company's assets will be a sum of the liabilities and equity.
Perfectly balanced, as all things should be.
The balance sheet is a good indicator of a company's financial health, as it provides a snapshot of the company's long and short-term assets and liabilities, and also its financial obligations. To determine the company is able to fulfill its short-term financial obligations, you divide the company's current assets over its current liabilities. This is also known as the current ratio. Most of the time, you want it to be more than 1. Else it will mean that the company has to raise cash either by taking on debt, selling assets, or doing equity fundraising, so as to fulfill all its near-term financial obligations. Also, take note for current assets and liabilities, there are things that can be easily liquidated or settled within a year. Staying on the section of current assets and liabilities, you will notice the terms trade and receivables under current assets and trade and other payables under current liabilities. Both trade and other receivables and trade and other payables are credit amounts that are pending settlement. Think of it this way. Let's say you purchase a pair of shoes from company A for $100 using a credit card. For company A, this $100 is recorded under the sales or revenue in the income statement, and it is deemed as a receivable that as the credit payment has yet to be settled. On the other hand, the $100 you just charged your credit card will be a payable to you, as you will have to settle it via the payment of a credit card statement when it is due. So when it comes to companies, think of it this way, but on a much larger scale and with much more cash involved. Hence, if a company has a large amount of trade and other receivables, you have to be sure that most, if not all of the amount, will translate to cash inflows into the company. Else, it will face issues when it comes to settling its payables. Another line item to note under the current assets section will be the company's inventories. Inventories is basically the physical stock that the company has in storage. An increasing amount of inventories might mean that the company is overproducing and not being able to successfully sell its products. The last thing to note on the assets section of the balance sheet is tangible and intangible assets. Put simply, tangible assets are quantifiable and physical, while intangible assets on the other hand are things that you cannot really see or touch. Example of tangible assets will be physical properties and factory machines, which are commonly classified as property, plant, and equipment. On the other hand, intangible assets are things like software, patents, and trademarks. One thing to note about intangible assets is that its value can be easily inflated by a company, as its monetary value is not easily quantifiable. This is also one way in which companies in bad financial health can make things seem a little more rosy than it actually is. By deducting a company's total liabilities from its total assets, you will then arrive at a company's net assets. This is also often known as the book value of the company. To derive the shareholder equity, you will then deduct any non-controlling interest for the company's book value. To determine a company's financial health, there are a few useful percentages and ratios that you can use. As covered earlier, the current ratio shows whether the company is able to meet all its short-term financial obligations. The debt to equity ratio shows how much of the company's equity is funded with debt. You will definitely want this amount to be as low as possible because it means that the company is not reliant on debt to grow shareholders' equity. The last important percentage is the return on equity. This is derived by taking the net profit or net income from the income statement and dividing it by the shareholders' equity in the balance sheet. This percentage tells you how well the company is generating profits based on its own shareholders' equity. Naturally, the higher the percentage, the better it is. So that's about all for the balance sheet. Let's now move on to the final financial statement, which is the cash flow statement. At its core, the cash flow statement is a record of the company's cash inflow and outflow. It's often split into 3 sections: cash flow for operating activities, cash flow for investing activities, and finally cash flow from financing activities. Let's go through these sections one at a time. So cash flow for operating activities is simply the cash generated or expense via the company's operations. Now I know, you'll be asking yourself, is this not already covered in the income statement? Well, yes and no. Remember how there are cash and non-cash line items in the income statement? The cash flow statement adds or subtracts these non-cash line items from the profit before tax to arrive at the operating cash flow before working capital changes. Working capital refers to the actual cash expense for both the company's receivables and payables, and also other cash reserved for special business operations. Now, if you're confused about the receivables and payables in relation to a company's cash flow, let me go back to the example of a shoemaking company. Let's assume company A has just received a big order for 1,000 pair of shoes from company B. Company A would then invoice the total price for the shoes, let's say at a total price of 100k, to company B. So in this sense, company A will record 100,000 as revenue for itself, although it has not received a payment yet from company B. Also, this 100k would be under companies A trade and receivables. So with the order of 1,000 pair of shoes, company A would then go to company C and order the materials required to make the shoes. Let's say the material cost price is at a total price of 20,000. So another invoice would then be sent to company C, and this 20k would be under companies A trade and payables, and will also be included in the cost of revenue in the income statement. In this sense, company A's profit will be 80,000 without any material changes to its inherent cash flow. So in company's A cash flow statement, it will be minus 100,000 for the trade and receivables portion and plus 20,000 for the trade and payables. So as you can see for the example, the cash flow statement really tells you how liquid a company is in its day-to-day operations. You definitely do not want a negative net cash generated from its business operations. Now moving on to cash flow for investing activities. This is basically cash received or used in the company's investments. So cash used could be for acquisition of other companies or just investing in better hardware or software to improve business operations. Investments to improve day-to-day operations is also known as capital expenditure, or CapEx for short. A useful term to note with regard to CapEx is the company's free cash flow. So you derive this by deducting the CapEx costs from the company's net cash generated from operations. This amount shows you how much cash a company makes in its day-to-day operations after accounting for necessary investments needed to sustain the company's business operations. For the last portion of the cash flow statement will be cash flow from financing activities. This section shows you the amount of cash that is paid or received from external parties not relating to the company's business operations. So the amount of cash received from bank loans, borrowings, or any form of equity fundraising, or the amount of dividends paid out to shareholders can all be found in this section of the cash flow statement. When it comes to dividends paid out, it's always good to divide it by the company's free cash flow, as this will show you whether the dividends are sustained by the company's business operations. If it's more than 100%, it means that dividends paid out are not sustainable in the long run, and it most likely will lead to dividend cuts in the future. Finally, at the bottom of the cash flow statement will be the change in the company's cash, after accounting for all internal and external inflows and outflows of cash, be it positive or negative. Phew, that was very long and intensive. But in essence, that's how you analyze companies' financial statements. And this is the first thing that you have to do if you're looking to invest in individual stocks or REITs. I know it may seem quite complicated at first, but after doing it for a while, it's actually not that bad and quite commonsensical. If you have any questions or doubts, leave it in the comments below. I'll try to answer them as best as I can with my limited knowledge and experience. As usual, if all this video helpful, I would really appreciate it if you drop a like on it, as a lot of time and effort goes into creating a video like this. With that, I will see you all in the next video. Goodbye.